To today's presentation, our first presentation for the year. And let me start off by just wishing everyone a happy and prosperous year ahead in the markets. There's a lot going on, a lot of volatility expected, a lot of big changes that we expect moving forward. But we hope to continue adding value to you guys, giving you great insights to see that these very turbulent times actually create a lot of opportunity. So we look forward to this year with you, and we again thank you for your support. So with that out the way, let's get into today's presentation, which we've titled the Double Doom Loop Dilemma. Where we're going to start is, as usual, with a little bit of a quote, just because it kind of sums up where we're sitting and kind of what we spoke about pretty much summing up last year, where gold is a language understood by all nations. And the reason we're starting this with this quote is I would like to just answer this question of what was the most notable thing to happen in markets in 2024. There was obviously a lot going on, a lot of big changes, a lot of political, geopolitical aspects at play. But for me, probably the most notable thing that happened in 2024 probably started in 2023, but was this 40% rally in gold. Whenever you see gold rallying like this, then you can expect there's something happening below the surface. Usually it's a risk-off situation heading into recession, but in this instance it was a little bit different, because the big difference we had this time is that we had gold surging in tandem with rising real rates. And when you see gold rising with real rates, it hints at a generational shift beneath the surface. It hints that something bigger is at play than the usual risk-off situation where gold generally flourishes. So what do we mean by real rates? Just to kind of sum up, or just to give a little bit of clarity to those that do not know. And why is gold defying its traditional inverse relationship with real interest rates? So basically, that relationship is where you have real rates, which is nominal rates minus inflation. So gold price and interest rates were basically inversely correlated, because if you have higher inflation, it means your nominal rates are being whittled away by inflation, basically. So if you have, say, 3% nominal rates, but your inflation is at 4%, then you're sitting with a negative 1% real rate. And if you put $100 in the bank at a negative 1% real rate, where you have the bank's offering you 3%, but inflation is sitting at 4%, at the end of the year, you're going to be sitting with $99 in the bank. So in that case, it's obviously better to hold gold. Gold is holding more value, because if your $100 worth of gold is going to be worth $100 at the end of the year, there's no yield on that gold, but at least your cash isn't being whittled away by negative interest rates. So when interest rates rose, gold prices fell because higher rates made interest-bearing assets, or IBAs, like bonds, more attractive relative to zero-yield gold. I.e., if you see nominal rates going up to, say, 5%, and inflation is still sitting at 3%, or let's say it's gone up to 4%, you have your $100 hold at 1% real rates, which means at the end of the year, you have $101. So in that case, it's better to hold interest-bearing assets like bonds. So that's the relationship between gold and real rates. Basically, when real rates go down, it's better to hold gold, especially when real rates go negative, or only when real rates go negative, it's better to hold gold. When real rates go positive, it's better to hold your interest-bearing assets. So over the past 2 years, we see this correlation breaking down, where gold prices remain strong even when you see rising real rates. So what this suggests is gold is being valued for reasons beyond its traditional role as a hedge against low yields and or negative real rates. So if we go back to that chart, you can see you have negative real rates sitting at 2.4%, and yet gold is still climbing, and again had a 40% year despite those falling real rates. When you look at the trend, you had a very strong trend to the positive in real rates as inflation started to come down, but gold continued to remain strong. So why do we have that? Why is that a factor? Well, in order to answer that question, we have to run you through a brief history of the current financial system. We've gone over this in much more detail in our previous presentations, but this quick summary should be a good reminder of that in 1971, the latest version of the financial system was basically born when Richard Nixon left the gold standard. It was cemented in 1973 when Henry Kissinger went to Saudi Arabia and he made a deal with Saudi Arabia to say, you can sell oil only in dollars, and in return, we will give you military support and all the benefits of that. And that's what was considered the greatest deal ever made. That's what we went through in our previous presentation. So from that point on, we start to see the rise of this petrodollar system. And with the petrodollar system, you basically have US treasuries as the gold reserve asset, because every country needs to have access to dollars in order to buy oil. In that case, they're going to be holding US treasuries in order to access dollars. And at the same time, which is an important part of that puzzle, is China's growth miracle. And they have these huge trade surpluses. Their biggest trading partner is the US, and they're starting to accumulate these US treasuries and US dollars. Or they're accumulating US dollars as they sell their products, and with those dollars, they're buying US treasuries. That continues for many decades, as these financial systems do. They last a very long time. And we head into the 2008 global financial crisis, where the US responds with massive amounts of QE. And then questions start to be asked about that response. Can we trust in this dollar? Is the US just printing as much dollars as they want without any consequences? Why is this affecting us? Why is oil going through the roof? We still have to buy this oil, but we are now buying it at a 40% premium to what we bought it last year because of the US's response. And those questions were being asked most importantly by China, where they started to say, the Chinese financial minister started to say, look, we need to look at a different strategy here. We need to look at a different global reserve asset that's not going to eat us every time the US creates its own pain by overdoing it on the debt side. So again, 2013, China's now learned its lesson. It decides what the US is doing is unsustainable, and we need to start selling off our treasury reserves. Basically, their treasury reserves peaked in 2013, and they start selling over the next decade. Then what happens then is 2020, the COVID crisis hits. 2022, the regional bank crisis hits. The UK gilt market has its little hiccups, and we also see Russia invading Ukraine. And with that, there was many different things that lead to more questions being asked about the current financial system. Firstly, again, US responds with massive amounts of printing money, COVID handouts, etc. Again, they're bailing out the bank crises, or they're bailing out the regional banks to the tune of billions of dollars in 2022. And they are weaponizing the US dollar against Russia as the sanctions kick in as a result of the Ukraine war. So from that point of view, we start to see, well, perhaps with China backing away from the system, and as we've discussed in the past, the rising influence that China is happening at a global level with the global south, especially the BRICS nations and the growing BRICS nations. Because again, as we said, it's not just the BRICS 5 nations anymore, it is the BRICS 30 plus nations. So with that, we have to look, well, potentially we're seeing a big change in the monetary order. And as we said, the reason we have that is we have a loss of faith in the US. The move to adopt gold over US treasuries reflects a broad loss of faith in US debt sustainability. And that's the narrative at the moment. There's this huge narrative of, can the US sustain these deficits that it has and the levels of debt that we have, which we'll get into a little bit later and which we've covered very substantially in the past. Again, it's this fiscal irresponsibility. We're losing faith in the US's ability to pay back its debts. And we have countries like China reducing their reliance on the US dollar and its associated assets such as treasuries due to concerns over US monetary policy, sanctions, and geopolitical risks. So we have this loss of faith, and with that loss of faith, you have this potential for gold's rise as a reserve asset. Gold's adoption as a reserve asset highlights its appeal as a neutral, non-sovereign store of value. We go back to the beginning where we had that quote, all nations understand gold, no matter the language. Unlike US treasuries, gold is not tied to any single country or subject to political pressures, making it a preferred asset in a multipolar financial world. So, as you can see, talk about the sustainability of US debt. Is this current path sustainable? and with zero effect on the US dollar and US treasuries. And when you look at this US treasury-based monetary system, the last 3 years have seen its biggest losses in 200 years for 3 years running. So you're holding all of these treasuries as your monetary backing, yet you've had 3 years of the worst losses since 1842, excuse me. So very, very big questions to be asked about this current financial system. And then, as you can see, it was 2008 where basically central banks started to accumulate gold. Russia, China, India, Turkey, a lot of that bulk, as we keep saying, the economic center point, let's put it that way, is moving to the east, as we've discussed in many of our previous presentations. So you can see gold very much growing as a hedge. Again, you're not holding dollars as FX reserves. These central banks are now starting to hold gold as FX reserves. And again, in terms of foreign trade between the BRICS nations, gold can become a strong trading asset rather than trading in US treasuries. So with that said, 2024 behind us, what is the most notable thing happening in markets now? Because the changing financial system is not the main focus at the moment. It's what's happening now. And the most notable thing to me at the moment is US bond yields versus China bond yields. You see the US bonds continuing to rally despite this understanding that inflation's coming down and the Fed has started cutting rates. So that's the big question. Why are bond yields rising while the Fed is cutting rates? That doesn't tend to happen very often. So the big question is, why is it happening now? Well, two reasons for that. Firstly, before we get into those reasons, just a quick 101 on bonds for those that don't fully understand bonds. When you have bonds, you have your yields. Basically, I put $100 into a 5% yielding bond over, let's say, 5 years. After 5 years, I get my full return of that investment, plus I get 5% per year. That's the yield that I'm getting. So selling bonds pushes their prices down, which raises yields. It's the return that investors earn. It's the reason that you get higher yields is that you need those high yields to attract new buyers into a riskier environment. So you just have to think about this in extremes. If you go to, let's say, Zimbabwe, and you had a 5-year bond at 5% yield in Zimbabwe, and they started with their monetary madness, you're definitely not going to put your money in for 5%. You're going to demand way more return on the risk that you're giving them your money because of the policies that they are busy enacting. So instead of saying, oh, I need 5% return, now I need, let's say, 30% return on your bonds because the money I'm giving you, I don't think I'm going to get it back. And if I do get it back, I don't think it's going to be of any value. So basically, rising yields reflects the market's concerns about fiscal sustainability, inflation, or broader economic risks. And when you see yields rising, it means you are demanding more for the money that you are putting at risk. I hope that's clear. So rising yields indicate that the market requires a higher return as the perceived risk of the investment has gone up. Said another way, as investors sell bonds, yields rise in order to attract buyers back into the market. So if I'm deciding, actually, I don't want to hold these bonds anymore, and I start selling them, then there needs to be a reason for someone else to buy them. And the reason they would buy them is that bond yields go higher. Okay, so reason number one, as we said, two reasons as to why interest rates are coming down and yet bond yields are going up in the US. And reason number one is what we call bond vigilantism. And in order to explain what bond vigilantism is, we're going to go back to the 1980s, where we had a very similar environment. You had high inflation, large federal deficits, and expansive fiscal policies under the Reagan administration's Reaganomics of the 1980s. And just coming out of that period, Paul Volcker, chairman of the Fed, had been pursuing aggressive interest rate hikes in order to combat the rampant inflation of the 1970s, the 1970s energy crisis that came, and again, the 1970s crises that led to the US coming off the gold standard. So when the Fed began cutting rates for the first time in May of 1981, the 10-year yield jumped almost 4%, highly unusual at the time. And the question is, why did this happen? Basically, investors had sold bonds on the news as they believed that the rate cuts would lead to a resurgence in inflation. The bond selling pushed yields higher and thus increased the borrowing costs for the government. And this created significant pressure for policymakers. So basically, the bond market was telling the government, hey, you need to keep your things in check because I'm not interested in your bonds if you are following these policies. And if I'm not interested in your bonds, you need to give us a higher rate of interest for us to come back and buy these bonds. And if you're giving us a higher rate of interest, you're paying a lot more on your debt. So what we're saying is that the bond market became this check on government behavior, and that's why they were called bond vigilantes. So in describing these events, a guy by the name of Ed Yardeni, a bond veteran, he's still in the markets today, he used this term bond vigilantes to highlight how bond investors acted as enforcers of fiscal and monetary discipline. This is the beauty of the bond market. And this is why they say that's where the smart money is. The bond market is the smart money, smart investors, and the bond market is where the truth lies. So it became a metaphor for how financial markets enforce discipline on governments that fail to manage their debt or inflation responsibly. So here we can see the top line where the 1980 bond vigilantes came into play. You see this big rise. And the only other time it's been that big is today, 2024. So it's a very significant chart of this to see the reaction to rate cuts that we are getting with the Fed. And there's very good reason for this. If you take a look at the Truflation Inflation Index, they're basically an independent inflation company that keeps track of the price of goods in the US on a daily basis. And you can see that basically inflation bottomed in September of last year, and since then rose from basically 1.7% to as high as 3%. And the Fed's telling us, yeah, well, inflation's under control, it's coming down, and yet we're seeing this big move higher. So there is this reason for concern. And even though we had this latest inflation print that came in under expectations and everyone was celebrating that inflation is a thing from the past, that inflation print was still 21.2% higher than December 3 years ago. So there's significant moves in the inflation market that the Fed is just either choosing to ignore, or there's something else at play that the Fed isn't being open about. Likely that the US debt markets, US financial markets are under serious strain at the moment. As we know, the commercial real estate crisis is a major issue when it comes to the to refinancing their debt. So maybe there's more at play than the Fed is leading on. And again, when you look at the Trump effect in full swing and this kind of reflationary environment that we're heading into at the moment, small business optimism has surged to 105. It's the fourth highest reading in history. You also have over 7 in 10 small businesses, 70%, planning to increase their workforce in the next 12 months. And as you know, wage inflation or increased employment leads to higher wages. And at the same time, Trump is basically getting rid of all the illegal immigrants, and the illegal immigrants are another way of saying we're getting rid of all of the cheap labor that we have in our country, which means, again, wage inflation. So you have these very inflationary policies coming into play in an environment where the US economy can't afford inflation. The Fed can't afford to have this inflationary environment. So it's very clear that inflation expectations bottomed as the Fed started its rate cut cycle, but the market isn't buying it. The market isn't buying that the rate cuts are necessary, and that's what the economy needs at the moment. So that brings us to reason number 2, the dollar doom loop. So as you can see, what also bottomed between September and October of last year was the dollar. And this is a significant move in the dollar when you look at this price chart, daily price chart. And why is the dollar rallying? Well, we have what we call the dollar doom loop. So let's start with the rising yields at the bottom, or let's start with the dollar strengthening, because that's what we're seeing on the chart. Dollar is strengthening. What does that mean? It means increased cost of US dollar denominated debt for foreign holders of US dollar denominated debt. Basically means their bills have gone up because in order to get their hands on dollars, they have to spend more money to get those dollars. And where are they going to get that money from? Well, they have to sell their US treasuries to cover the costs. What happens when you sell your US treasuries? You have rising US yields. what happens if you rising US? What happens with rising yields? You have more dollar strength. What happens when you have more dollar strength? You have more global economic pressure and risk off, which leads to more dollar strength, which leads to increased cost of US dollar denominated debt, and round we go. And this is what we call the dollar doom loop. This has been in play for many years, but it is getting worse over the years. It's getting more pronounced over the years. It's adding to increased volatility over the years, and that's where we are at the moment. And just as a side note, when you take a look at GDP per capita, especially over the last kind of I would say, let's say 5 years, over the last 5 years, you can see that basically the US is on its own runway, which makes it the only game in town. And if you want to play that game, you need dollars. So in order to get your hands on dollars, you have to buy dollars, and that brings the cost of dollars up, which again leads to the dollar doom loop. Dollar strengthening equals cost of dollar debt going higher. Okay, so the dollar doom loop dilemma leaves the Federal Reserve caught in this policy trap. So raising rates will strengthen the dollar, increasing foreign sales of treasury. So if we see a resurgence in inflation, the Federal Reserve is in serious trouble. Cutting rates at the moment risks higher inflation and could lead to further bond vigilante selling of US treasuries, which again leaves the Fed in a very serious position. So while the dollar doom loop reveals the strain on global markets from a dollar strength, its impact directly ties into another critical domestic issue, which is the sustainability of the US deficit. So there's so many intertwined aspects to this situation that the fragility of the financial system at the moment cannot be understated. So we are sitting with a 7 to 8% deficit. Basically, when you talk about the deficit, just for those that don't know, it talks about how much is the US spending versus how much money are they receiving from tax receipts. And this is why we're talking about Doge and Elon Musk coming in to create this this Department of Government Efficiency. If you can cut the efficiency of the government, then your expenditure can come down and you can reduce the deficit. That's the theory, at least. That is very questionable whether Elon can reduce the deficit, and we'll get to that in a second. Let's just go over some quick notes for what's happening with the deficit at the moment as we stand present day. The US budget deficit hit a massive $711 billion for the first 3 months of the fiscal year 2025. This is 39% higher than the same period last year. 39%. So what we're saying is, yes, we are looking to bring the deficit down, but at the same time, our deficit's gone up 39% from the one that we had last year. Last year was a problem, but we're 39% higher than last year, and we know we need to bring it down. Deficit reached $2 trillion for the full calendar year 2024, up $248 billion year on year. Deficit spending rose from 6.4 to 6.9% GDP 2024. And such a high percentage has never been seen outside of wars or major economic crises. So, substantial situation that we have with the current US deficit. So even if Elon can reduce wasted expenditure on the margin, the most difficult expenditures to cut, which are basically your interest on outstanding debt and entitlements, which is your healthcare, your social security, your unemployment, etc., are currently equal to total tax receipts, and that's where we have the major issue. So in order to cut down on healthcare, social security, unemployment, that doesn't make your voters happy. That's why governments are so resistant to do those cuts. What you're talking about there is austerity. You're talking about austerity measures, which no government wants to implicate or wants to press onto its voting citizens. And again, you have your interest on your outstanding debt as a result of high yields. So we did the little recap of the US debt situation back in June of 2024. And we spoke about the Smith family, and we kind of equated the Smith family just to get the numbers into a level where our brains can understand. So the Smith financial position is that they have an annual income of $44,000. They've got expenses of $61,000, which means a $17,000 shortfall on their credit cards each year. But they've also got total debt on their mortgage, etc., and car loans of $340,000, and basically the cost of maintaining their children as we said, and interest expenses alone equated to 44,590, which means their annual income does not cover their annual expenses that they are very unlikely to cut. When we talked about their dependents, we said basically their school fees, etc. They would have to pull their children out of school in order to maintain those dependents. And that's kind of how we equate to austerity measures of cutting healthcare, social security, unemployment for a government. It's like a family pulling their children out of school. It's the last thing you're going to be cutting. So back to US fiscal position of 2023, things aren't much different. They're probably much worse actually in 2024. But tax receipts, 4.4 trillion. That's why we used 44,000, just to give you that number that's more understanding to our brains than 4.4 trillion. 4.4 trillion in tax receipts, interest and entitlements, 4.4 trillion. So you're basically in this position where all the money you're getting is going to maintaining your debt and paying for your children. So with that, we need to talk about the stock market's role in tax receipts. So capital gains tax, we all know what capital gains taxes is. A major portion of federal and state tax revenue comes from taxes on profits made by selling stocks or other assets. Falling stock prices lead to fewer gains being realized, reducing this revenue. So basically, if the stock market begins to fall, then your income that you're receiving from taxes as a government starts to fall with it. And a lot of that because of stock-based compensation. High-income earners often receive stocks as part of their pay. When these stocks are sold, they generate taxable income. So declining stock values reduce the tax revenue from these sources. And that's where we have what we call state-level dependency. States like California and New York are highly reliant on capital gains taxes for their revenue, especially from major tech companies. An example we can use for that is that 10% of California's budget is currently coming from the capital gains tax on executive stock compensation from just 4 major tech companies. So I'll let that sink in for a moment. 10% of California's budget is coming from executive stock compensation capital gains tax. So if the stock market begins to fall, if tech stocks begin to waver, there is a major revenue problem for states like California. And it's not just California, this is a statewide situation. California is just kind of one of the leading examples of that. And we saw this during 2022. The US federal tax receipts dropped unexpectedly as stock prices fell sharply. Obviously, 2022, we saw a big dip in the markets. And with that, we saw US federal tax receipts drop significantly. Capital gains taxes, which had contributed to high revenues in prior years, plummeted. This revenue decline contributed to a sharp increase in the federal deficit despite relatively strong GDP growth, highlighting the dependency of US fiscal health on stock market performance. So basically, your tax receipts are highly correlated to whether the stock market is going up or whether the stock market is going down. With that, I also want to add in the fact that we are more than likely living in what we call a markets-driven economy. And when you look at PCE, which is consumer spending on goods and services, it's also the Fed's main metric when it looks at in terms of where's inflation lying. Basically, consumer spending, it's not just about inflation, it's about how well the economy is doing. It makes up about 67% of US GDP. It's a key driver of economic growth. In 2024, 100% of PCE growth came from, want to guess, net capital gains, which was income from rising asset prices like stocks, and taxable IRA distributions, which is your retirement account withdrawals, which are very strongly linked to the stock market. So basically, without the stock market rising, there would have been no growth in consumer spending. So this very strong consumer economy, which we've been arguing is a big recipient of government spending from the Biden administration, is also very strongly driven by this market-driven price dynamics. So why this matters? Heavy reliance on financial markets makes PCE vulnerable to stock market downturns. So obviously, your economic growth becomes very closely tied to how well stock market is doing. And if asset prices decline, consumer spending, and by extension, the economy slows dramatically. So we're living in this wealth effect where stocks are going up, continue to go up, the passive bubble continues to climb, people are just buying stocks every month, And with that increase, you have this increase in feeling that, oh, I'm so rich, I've got so much money in the stock market, and it keeps going up. I'm going to buy some things for myself. Things are going really well. And that's what leads to a market-driven economy. The big problem with this market-driven economy is that whichever metric you look at, the stock market is sitting at historically high valuations, very much approaching the NASDAQ bubble levels, only just short of the 2020 stock market bubble that we had following COVID and all of that hysteria that occurred. I think we're going to surpass that in the coming months as this kind of Trump euphoria comes into play. But no matter how you look at it, the stock market is very, very strongly valued at the moment. So what that means is future returns are in question. What we have here is on the left, S&P 500 forward PE ratios and subsequent one-year returns. So in 1 year, anything can happen. Basically, you could have a year of minus 25% declines. You could have a year of plus 40% declines. But over the next 10-year period, the best case scenario you could have is a plus 1% return on stocks. As you can see, the outcome from the current level of forward PE ratios over the next 10 years is more than likely in negative returns annualized. So future returns are in question. While every man and his dog has a seat at the table, stock markets have never been this oversaturated in terms of the number of people holding stocks and the number of organizations holding stocks. And not only that, when you look at the concentration of stocks, it means the emergency exit has never been narrower. This top 10 stocks in the S&P is valued at 38% of the S&P. So it's a huge amount of concentration at hugely elevated levels, with very low chances of 10 years returns in the positive, and every man in his at the table, every man with a seat at the table, because of what we spoke about in our previous presentation, the moneyness of stocks. People have this preconception or this misguided perception over the basically long, strong uptrend of stocks is that your stocks are as good as cash. That's true in an up market, but it's not true in a panic/carry trade unwind. And that needs to be front and center of our minds moving forward into the current environment. So the question now becomes, at what bond yield do investors decide that bonds are more attractive than stocks? And I would just like to add to that chart this 5% yield on bonds that you can get at the moment. Obviously, that's a little bit different at the moment. So it's going to go up more than likely to 5% in the coming months. But at the moment, generally, this pink line is where you can get returns over a 10-year period if you had to put all of your money in stocks. Any financial manager looking at a 10-year subsequent returns needs to look at this and think, well, it's probably time to get some exposure to bonds. And on top of that, you need to look at generational wealth by age group. Boomers hold 52% of net wealth in 2023. That's gone up substantially more given the market prices we've seen over the last year. And baby boomers are heading into retirement. They can't afford to ride through a 10-year market turn down. So what does that mean for baby boomers that hold 52 to 60% of the wealth in the markets? It means there's big incentive to migrate to the bond market. It means, well, I've had a really good run. This market's looking pretty oversaturated. Let's start offloading some of this, put it into a 6% or whatever the bond yield's going to be that drives them out, put it into that bond for the next 10 years, and that's my retirement sorted. I don't need to worry about finances for the rest of my life. And what do we have with that mentality? We have what's called the bond doom loop. So we have higher yields, which creates an incentive to own bonds over stocks, which creates falling stock prices, which lowers the tax revenue of the government, which leads to worsened deficits, which leads to increased borrowing pressures on the bond market, which leads to higher yields, which leads to incentives to own bonds. So again, we've got this doom loop of the bond market where falling stock prices create serious issues for the US government in terms of revenue and worsening their deficit. which then leads to higher bond yields, and round we go. And with that, we have our double doom loop dilemma. You have the offshore market trying to get their hands on dollars, which creates upward pressure on the US yields, which leads incentive to sell US treasuries. And again, those higher yields are then domestically incentivizing the baby boomers to own bonds over stocks, sell their stocks, lower tax revenue for the government, worsen deficits, increase borrowing pressure on the bond market. Round and round we go. So with this double doom loop dilemma, there's one thing we haven't spoken about yet, and that was the other aspect of our most interesting thing happening in markets at the moment: China 10-year yields diverging from US 10-year yields. What is the reason for that? Why is the China 10-year yield plummeting when US bond yields are heading higher? Well, one reason, obviously, a lot of pundits talking about the China economic slowdown and debt deflation, real estate crises, etc., etc. That personally, I believe, is questionable. I mean, we're 6 years into China's real estate issues, and our deep dive into China just showed you how China's monetary system is very, very different. China's political system very, very different to what we are used to in the West, what the US system is like. Another important reason, which you see in the chart and we'll get to in a moment, is Trump's promise of tariffs and economic threats. So when you have economic threats to China, basically what they're saying now is, okay, well, we've got this enemy, this Cold War that's occurring with the US at the moment. We can't hold these US bonds. Obviously, with the sanctions, etc., hanging over our heads, it's probably more than likely a better alternative for us to start offloading our US dollar debt. And what are the banks doing with that cash? They are putting it into Chinese bond markets. So regardless of whether you're seeing a China economic slowdown and debt deflation, or you're seeing geopolitical dynamics at play, both of these scenarios equate to higher bond yields for the US. It means bond sales, which means to higher bond yields. And as you can see, even though China started offloading their debt in 2013, they are still the second biggest owner of US foreign denominated debt in the world. Japan's the first one, and that needs to be considered in terms of the carry trade unwind that we spoke about, that we believe is still not done, and is likely to play out in the near future. It's going to be part of the future issues that the US global or the global economy and Jerome Powell is going to be having in the future. But the focus here at the moment is on China. China starts unwinding its US debt positions. It just yields to higher bond yields. And again, you can see when Trump was elected, you see that acceleration to the downside. Basically, China started to offload more of their bonds with Trump coming in and threatening with all of these tariffs. And again, we spoke about this previously. Trump tariffs, is that inflationary, deflationary? We're not sure, but very likely it is going to play a psychological role on the inflationistas, which again, there's just, what we're trying to say is there's a lot of tailwinds to inflation expectations, which is a big tailwind to bond yields in the US rising, which again leads to the double doom loop dilemma. So adding in China selling treasuries to the doom loop dilemma on both sides equals higher yields. And with that, the double doom loop dilemma gains its strength even more. So I hope this has opened your eyes to a potential situation playing out with regards to the current global financial system and why you're seeing things like Bitcoin and gold rallying the way they have, and more than likely will continue to rally the way they have. And with that, the summary of today's presentation is gold's unprecedented rise alongside real rates signals a deep shift in the financial principles the world has been operating on since 1971. The dynamics of the US bond market are changing, highlighting the systemic fragility present in global markets, and the Fed and US government have exceptionally limited room to maneuver in current conditions. What we didn't speak about, and which I think we'll probably need to revisit in the next presentation, is yield curve control, which basically leaves the US government's only option, given the current financial situation, as yield curve control, which means they start to control the yield curve, bringing down the long end so that these bond vigilantes can't let the yield curve run to ridiculous levels. But again, we'll have to cover that in a different presentation. That's a potential outcome and second order effect of the current situation. But I think what needs to be highlighted now is this double doom loop dilemma and the potential after effects of that. So with that being said, you would probably think I'm a massive dollar bull to start the year, but that is not the case, and a stock market bear for that matter. That is certainly not the case at the moment. I think we're going into a period of Trumphoria, and I think that's going to push the S&P to around about 7,000, potentially beyond that, and bond yields to 6% plus. What I do predict for 2025 as well is definitely a large increase in volatility. It's when you start to see the S&P to 7,000 and bond yields at 6%, where that dynamic of boomers looking at this thinking, this is potentially a good place for me to unwind some stocks and get into bonds. Prices are looking really good on both sides. I'm selling at a great value and I'm buying bonds at great value, and this pays for my retirement for the next 20 years. So with that, I think we'll see a resurgence in inflation given Trumphoria, and that is going to be a big driver in pushing bond yields higher. The Fed's going to get trapped. We're going to see gold up to 3,000. We're going to see Bitcoin 145K plus as those kind of continued dynamics come to play, which we spoke about earlier. With an increase in the stock market and gold and financial assets, you're going to see a growing wealth gap, which is going to lead to further social instability. The uproar with basically CEOs getting killed and people celebrating that, things along those lines, those are going to accelerate. This could potentially be accelerated even further as AI accelerates unemployment for certain individuals. So a lot of social instability, I believe, over the next 4 years for Trump to deal with. And you can see increased instability over the next year. I suspect we're going to see some sort of sovereign debt crises in emerging markets, given the potential debt dynamics at play. I think that's only going to come towards the end of the year, but definitely something to look forward to in 2025. I think you're going to see a worsening situation in Europe, Germany under serious pressure. With serious economic pressure comes serious social instability. So watch for that. I think the energy crisis is going to worsen in Europe. I think you're going to see nationalist riots and potentially a Frexit, potentially an Italian exit from the EU. I think there's going to be a lot of pressure on the EU and EU leaders and further separation within the EU and EU policies. There's going to be major immigration issues for the EU where they start to kick out their immigrants. I think they're seeing a lot of rhetoric around how immigrants are ruining Europe, and these nationalist policies are going to jump on the back of that. You're going to see nationalism continue to rise throughout Europe, nationalistic governments coming into play, and a separation of European members. You're going to see deglobalization furthering, which will further cement China's rise. With the BRICS nations, the global south will continue to perform really well under China's guidance. And I believe we will finally see that US recession heading into Q3, Q4. Again, when you look at AI accelerating unemployment, when you're seeing US recession accelerating unemployment, with that unemployment comes a decrease in the passive buyers of US equities. And when that passive tailwind starts to dwindle, then you can start to expect a lot of pressure on the stock market and big volatility to the downside. People lose their jobs and need to start selling their stocks in order to maintain their lifestyle. Not only are they selling their equities, they've also taken away the buying impulse of the passive crowd, which again leaves a big flaw, or a very thin flaw, underneath the stock market. And I think you could see some very strong declines heading into the end of the year. But as I said, and with that, you're going to see that double doom loop come into play. But as I said before that, I think Trumphoria is going to push the S&P to 7,000. A lot of that is based on our technicals and the technical charts that we're looking at, which is what we will need to look at next. But I think I'll save that for a separate video. There's a lot to digest today. I will send a full 2025 technicals breakdown in the future, in the near future. So we look forward to sharing that with you guys. And again, just want to thank you all for your support, and I hope this has been insightful. And again, we will continue to provide the value we've been providing over the last decade or the last few years, 5 years now we've been running, and we look forward to providing these insights and the clarity that you guys need in today's markets, which are increasingly volatile and increasingly complex. So we look forward to being on this journey with you, and as I said, providing the value, to continue providing the value which we have. So again, thank you for your support, and we look forward to navigating this year together. We'll chat again soon.